What if the money that saves your business today destroys it tomorrow? Many founders don't fail because they lack funding. They fail because they accepted the wrong investor deal. Today, you'll learn how to tell if an investor is offering you a good deal or quietly setting you up to lose control of your business. This applies whether you're talking to angel investors, venture capitalists, or even crowdfunding backers. Let's begin. A good investment is not just about money. It's about what that money costs you over time. When an investor funds your business, they're buying ownership, and ownership always comes with influence. So the first question you must ask is simple. How much equity are you giving up, and how much control are you keeping? If an investor wants a majority stake early on, you're no longer building your company, you're building theirs. Strong founder deals leave meaningful equity with the people who started the business. Next, never judge a deal by valuation alone. A high valuation can hide dangerous terms. A good investment deal includes fair profit sharing, reasonable exit clauses, room for employee stock options, and no extreme preferences that drain all value when the company is sold. Bad deals rarely look bad on day one. They reveal themselves only when things go wrong. Now let's talk about trust. An investor is not just funding your business, they are becoming your long-term partner. Good investors are transparent. They want you to build a strong, sustainable business. They care about customers, operations, and long-term growth. If something feels off during negotiations, don't ignore it. Your instincts are your first warning system. Just as important as spotting a good deal is avoiding a bad one. Here are the biggest red flags. First, investors who don't want your advisors involved. If someone tells you not to consult your lawyer, accountant, or financial advisor, walk away. Good investors welcome scrutiny. Bad ones fear it. Second, unreasonable return demands. Investors deserve returns, but if a deal requires them to get 2 or 3 times their money back before founders see anything, that deal is structured for you to lose, even if the business succeeds. Third, excessive fees and so-called broker investors. If someone charges high upfront fees or promises access to an exclusive investor network for a commission, you're likely dealing with a middleman, not a real investor. Fourth, vulture investors. These are the most dangerous. They offer low interest rates, tight repayment deadlines, and harsh default clauses. Their goal isn't your success. Their goal is your failure so they can take control of your business. And finally, fake investors and swindlers. Some people posing as investors only want access to your financials, suppliers, or marketing strategy. Always research investors thoroughly before sharing sensitive information. Now, let's quickly cover who you should raise money from. Venture capitalists typically fund high-growth businesses and often require significant equity. Angel investors are usually individuals investing their own money and tend to be more flexible early on. Crowdfunding investors are many small contributors, which can reduce control loss but increase communication responsibilities. The key is simple. Don't pitch everyone the same way. Pitch the right investor the right story. To secure the right investment, follow 3 steps. First, define your perfect investor. Know who you're looking for before you start pitching. Second, lead with numbers, not just vision. Clear projections build confidence. And third, be persistent, not desperate. Rushed decisions create bad deals. Here's the final takeaway. A great investment deal does 3 things. It funds your growth, it protects your ownership, and it strengthens your business for the long term. Money should accelerate your vision, not replace it. If you found this useful, subscribe for more content on smart funding, wealth building, and founder mindset. And remember, invest smart or don't invest at all.